Hello, today is the 19th of February 2011. Welcome to today's silver video. And today, gonna go over some different things, at least a little bit differently than normal. Go over a few introductory things to start off with, then a chart. But this one's going to be dedicated to J.P. Morgan. And we'll also take a look at a little way of seeing how the physical supply and demand works and how the prices work within the premiums of silver. We'll do that at the very end. But before we begin, I made a little spelling mistake in here. Yeah, really, if you do search, this letter comes after the A, but when you try to type fast, I guess that's what happens. But I did a search for silver on YouTube. And my first video was found on page 9. Very interesting. And that was the 2011 Silver Forecast $100 Likely, Part 1 and 2. And that was one of my favorite videos. And it's very rare that when I look at the technicals for almost any chart that I can look at and say, you know what, yeah, but a 220% increase is likely. But that's the case right now with what silver is going through. Then I did a search for silver bullion. And you're going to have to go to page 28 as of this morning to find any one of my videos. And that was the 100 mils silver and gold bullion. Beware it's a scam that I did a few months ago. And it's very interesting because if you go to the tags of almost every single video I do, this is the first word and this is always the second word because that's what I recommend, or at least that's what I prefer for myself. I'm not advocating or I'm not disadvocating paper silver, but you're not getting silver because your payout will be that in fiat dollars. Now, if that's something you would rather do yourself, then that's up to you. Myself, I enjoy the actual physical itself. I was able today to pick up a very, very small amount at $33 per ounce. So I was very grateful for that, but it is getting hard to pick up silver at this time frame, and we'll go through that at the end to show you why. Silver charts. If you do a YouTube search for that, I nail this one. I'm on the first 2 and 7 total on page 1. And if you do a search for technical analysis, page 26, and you'll get my September 25th video. Moving on to the second part, I have a comment I want to go through. And this is regarding logarithmic charts, and it says, I have a problem seeing that it is valid to draw a straight line on a logarithmic chart to investigate trends. The reason I say this is that on a log chart, a straight line would not be a straight on a linear one. If trend analysis theory allows you to predict from a straight line on a linear chart, how can that be valid on a logarithmic chart? Confused. Well, of course, if you draw a straight line on a logarithmic, it won't be straight linear because this baby ain't straight. It's got the little curve, but that really just shows you how exponential growth works. So it's pretty cool to see, at least to a point. And this has a starting value of 100, and it increases over 20% over 62 periods. So when you look at this chart, it seems as if it does nothing, and then all of a sudden just explodes. Well, while the whole time it always increased at the same variables. And I think that can be extremely important because if you draw a straight line on a linear chart, then it's not going to be a straight line on a logarithmic chart. But what happens is whenever you draw a straight line on a logarithmic chart, what you are essentially doing is always having a percentage increase or decrease depending on if it's an uptrend or downtrend that is the exact same. That is not the case in a linear one. For what happens is the percentage increase and decrease will always start to go lower and lower as the trend continues. And that's really all I need to point out about that. I get confused why so many traders have so much disrespect for logarithmic charts. I'm only guessing that they're confused, that they don't understand how efficient this really is. But I really, really don't know. This works for me, and really if you're doing whatever, do what works for you. But for myself, I find logarithmic works so much better. Anyway, Moving on to a chart I'm recommending, or not recommending. This baby is for J.P. Morgan. And I say this because this is your chart. Sort of like that one song. This is our song. This is your song. I don't know. This is your chart, J.P. Morgan. This is silver reversed. And really, this is what you'd be doing if you are shorting silver. So this is not only for J.P. Morgan, but this is for anybody out there who is shorting this white metal right now. It's got to be done. It really, really has to be done, because when you look at this, how can you call a bottom in here? Think, yeah, this looks like a bottom to me. It's just down so much. We were way up here. It's got to stop going at some point, don't you think? Well, no, I don't think. But what I do think is technical analysis using Fibonacci, which is what I'm going to do here. And that's not what I want to do. That's what you're going to see at the end of this video. But what I want to do is, you see here, there's the number on the bottom part of the screen. I'm going to be using that for Fibonacci. So if you're using MS Paint, you can use this type of trick if you want. There's other ways of doing it, but for exponential Fibonacci, what we will do is we're going to draw a straight line at this top. We'll figure it out right there, and we'll figure out what that number is. See that 21? That's where it is. So just so I know, or I don't forget, I'm going to write 21 in. Now to get the bottom, I'm going to have to move this down a little bit, but I can figure out what the number is and then do some math. So we'll do a straight line again towards this bottom, and we get the number 432. So now on a pixel level, the difference is 411. So we'll get a calculator out, and we'll take 411, and we'll multiply this by 61.8%, which is significant Fibonacci. This is really 254. So we'll take 432 and subtract 254. That gets us 178. So what we're going to do is we're going to try to find 178 on this thing here. We see 220, and there's 178 right there. So now this is the key Fibonacci level right in here. Now notice what happens from this move lower. It found resistance at this point. This is good, I guess, if you're looking to short it. But even if you're looking to go long, this is a spot where on a bullish and bearish case, you're supposed to top here, and it did. So as this market's going lower on this example, you still really don't have any idea, just by using the charts, where it's going. Find a nice little bottom. Now what happens here is this increases the chances it breaks through, or it reduces the chances it's resistance. It was great chances here. It was not as good here, and it still was. But you found a higher low. That's strong. So the chances you break it here are bigger, and you do. So there's a nice breakout. So now what you want to do is you want to find support at this level. And even though it breaks below, it goes above and below, that's normal, and that's fine. You have a little bit of a bear trap in here, but you're back in here, and it was not able to break that resistance, which is quite weak. And when you have this much test of a key support level like you do here, it's no surprise in here that you broke below that key Fibonacci level. Excellent, excellent, excellent. So now we're going to continue on with some Fibonacci. And what we're going to do is we're going to calculate the difference from this high and this low. So we'll draw a new line. We'll draw it right in here. There we go. This is a nice little line. So now, you can't see the number on there, but it is a number of 135. So now the difference between 432 and 135 is 3 less than 300, or 297. So we'll do the math again. 297 multiply 61.8%. That gets us 183.5. So we'll just say 183, I guess. And we'll take this number and we will add it from the 135 variable, and that gets us around 318, 319. So if I find 318, 319, it would give me a mark roughly around here. So this was the key Fibonacci that it needed to hold for this rally in here to be that of a successful one. Obviously it found support here, but it didn't here. And when you break below it, it's goodbye. You're back down to this. You're going to this previous low, which is 50. So it's good to short this chart, which is in reality buy physical bullion silver. That's how you do it, is you buy physical bullion. That's how you short this chart. Now another secret in figuring out Fibonacci is what we'll do is we'll connect the difference between this high, or this line and this line, right down to this point here, and we'll move it down from here. And now this is the significant Fibonacci on the other side. Notice what happened here. There was no support here. Just because an area is supposed to have support doesn't mean it will. But the secret is to adjust to the message of the market. So now that you see it breaking below, you've got to be telling yourself, it looks like we're going to have a test up here, which is exactly what happened. And when you have a test here, find resistance here and go back lower, it's lights out. Thus, failed move. This rally, a failed move. Or in reality, the sell-off during the 1980s and 90s is that of a failure. But because this move here to here did not confirm a breakout above this mark here, this part here is a success, which is this rally from the 1970s. Okay, so now we're going to finish this off, and I want to show a little small quick demonstration on the buyers and sellers. Now I imagine this to be a football field. This is one side of the field, this is the other side of the field, and everything around here is your seats, your stands, where your fans are. And what I want to imagine is we have buyers on one side. These are, say, the left side is buyers, right side is sellers. So just imagine in here you have 500 people who want to buy silver in here. So you stick 500 people on this side of a football field. And here you have 500 people who want to sell their silver. What's probably going to happen is the buyers and sellers are going to communicate with each other. Everything's going to be fine. And what's going to probably end up resulting is almost everyone's going to sell and almost everyone's going to buy. So therefore, what's going to happen is all of the buyers we're going to assume are now going to be in here. So let's just say you have 500 people who are holding silver. But let's just assume 400 people hold, and because all these people bought, the price went higher. So now what we have is of those 500, 100 people want to do a quick profit take. So now you got 100 sellers in here. People come in and flood if, say for example, only 25 people enter the stadium who want to buy. What's going to happen here is these sellers are going to try to get rid of their price, but there's not much of a demand here. So these people here are going to be in control, and they're going to be stating, okay, wait a second here. Okay, no, wait a second. The sellers, yeah, because there's only 25 buyers. So what's going to happen is 3/4 of these people are not going to be able to sell. And generally what would happen is a reduction in the price because the demand is lower than the supply. But let's assume there wasn't 25 people who wanted to buy. There was 400 people who wanted to buy. Now what's going to happen is there's going to be many buyers who are going to be shut out because there's only 100 that is available on the market. Yet 400 people want to buy. So now the people who are in control are the sellers. And they're like, okay, wait a second here. They see a mass of buyers coming in, and they realize that they can increase their prices because of this demand. And that's pretty much what is going on within the physical market today, is the amount of buyers are exceptionally higher than those that are looking to sell. So therefore, what most likely is going to happen within the physical market is when buyers are much higher than the sellers, the premium over the spot price will go much higher. But if you get to a situation where everyone wants to sell and there's not many buyers, and let's assume spot price is 500, well, you might be lucky to get 400 because there's a lack of buyers and there's more sellers entering the market. So there's a little basics to what's going on. And really the whole point of this is just one way of stating, if you look at what reality is going, I don't have the stats on me, but it's pretty obvious to see that there is a lack of sellers on the physical market than there is people who are looking to buy. Thank you for watching. Have yourself a great day.